start with the bonds. Tell us what's going on with the bond market here in the US.
Yeah, so this seems to be slipping under the radar of just about everyone. I've been trying to make a stink about it on Twitter, but it seems nobody's really caught on to it yet. So the short end of the United States bond yield curve is basically ignoring the Fed's fund rate completely.
Everybody, this is 𝙎𝙊𝙇𝙍𝙍, goldsilverpros.com. I have a returning guest of the program. You haven't seen him in a while, but we've got a lot to cover today. It's 𝙬𝙊𝙇𝙍, who also goes by Deso Games on Twitter and on Twitch, where you can capture him talking about the markets and also doing his gaming sessions. 𝙬𝙊, how are you doing today?
I'm doing well. How are you?
Not too bad. It's been a long day, conference yesterday, so wrapping this one up after this recording, but we had to get you on tape because you've got an interesting situation with the bonds going on and also some observations on silver. So let's start with the bonds. Tell us what's going on with the bond market here in the US.
Yeah, so this seems to be slipping under the radar of just about everyone. I've been trying to make a stink about it on Twitter, but it seems nobody's really caught on to it yet. So the short end of the United States bond yield curve is basically ignoring the Fed's fund rate completely. I don't know why, but honestly, since it started after taper was announced or started in November, and it continues to this very day, I'm just thinking that the bond market, at least the short end of the curve, has basically stopped believing the Federal Reserve. In other words, the Federal Reserve has lost all control. And I don't think anybody's come to this conclusion yet. Well, some people have stated it, but I don't think anybody's ever given any evidence to this fact. And the short end of the curve for the United States is basically screaming that the bond market no longer believes the Fed, while everybody's concentrated on the long end of the curve, so they don't see that this is going on under the hood. But the patterns are clear, and I aim to show that today.
Okay, cool. Well, go for it.
All right, well, I'll share the screen then. Get into the nitty gritty. So here's the bond yield curve for just to begin with, trading today on the 27th. And you can see that the short end of the curve has blown out while the longer end has contracted. Now, most attention goes out to the US 10-year, considered to be the most safest trading asset in the entire markets, most liquid and everything. But again, I'm focused on the short end of the curve. Now, if you look at the short end of the curve, and I've got the 1 year open here now, on the long term, it looks like the federal funds rate. As we know, the Federal Reserve sets the interest rate for the US bond curve by basically setting it for the shortest term rates, the overnight repo rates. And they've got an effective funds rate, which I've got open here, which is currently set to 0.08%, as it has been since the start of the pandemic. We know this. However, what has changed is that the bond market is now ignoring this rate at the short end completely and has blown out. And I can simply show that by showing you the shape of the curves. This one and this one. And you can see here at the end, it's completely flat. And here in the one yield curve, it has gone up nearly 10 times since September of last year. So the interesting thing here is that until September last year, the 1 year bond yield followed the Fed funds rate very closely. The longer you go out in the curve, the less close they do. And I can show that by the 2 year chart, which I also have open here. And switching between them quickly, you can see the change in shape of the chart.
But the 1 year is really pronounced. It looks like the 1 year people are pricing a lot more risk.
Well, you would say that, but that is how you can check this. And I think that is why it goes over one's head. On this chart, if you just look at where the line is now, you can see it's trading exactly around the 1st of December 2016. That's averaged out over a monthly chart, so you only get the 1st of each month. But that's the same for the federal funds rate. So since the bond is trading where the same interest rate used to be in December of 2016, we just check where the federal funds rate used to be in December 2016. And that is here. So that is the real problem here that nobody seems to get. The bonds are already trading, at least on the short end, as if the Federal Reserve has already hiked rates twice. So at this point, the Federal Reserve can hike rates twice, and it wouldn't even matter for the short end of the curve. You wouldn't even be able to see it because the 1 year, the 2 year, the 6 month, they're already trading as if it's the federal yield curve is at 0.5%. Now, of course, the bond itself isn't trading at 0.5%, but the Federal Reserve does set the entire yield curve by simply setting the lowest one. It's the further out you get that it changes from the federal funds rate. It starts fluctuating more. But the closer you get in lending time, so the shorter in lending time you get to, say, overnight repo, the closer you are to the actual Fed funds rate. Now, if we look at the 1 month bond, it is still following the Fed funds rate or trading to where it is supposed to trade in a situation like this. But the 3 month has already completely started ignoring the Federal Reserve, and it has since the 3rd of January, which is where the Federal Reserve announced that quantitative, well, not announced, but they started discussing running off the balance sheet faster.
Right.
So in the situation where the US government has to lend trillions in budget deficit because otherwise they can't, afford their spending, they're actually going to add bond supply to the markets. I am just in awe of their stupidity at this point. Anyway, the short term of the curves spike more because it's large amounts of money moving in and out. They're only used as short-term liquidity by companies in effect. But if you take a longer-term view, you can immediately see that it too used to trade pretty close to the Fed funds rate, especially on the weekly chart. You can see that it just accepted where it was. And then since the first week of January, it has just gone up and up and up. And while on the very short term, you might see these individual spikes themselves also go higher because this spike is the same as this spike, but now it's happening from a higher base. And that is the chart with the 6 month, the 1 year, the 2 year. But the further out you go, the more flatter it gets. Now, people have been commenting that the yield curve is inverting because of policy error from the Fed, which is true, but it's going to invert around the 10-year level. As you can see, the spread between the 10-year and the 7-year is basically nothing. So we could very much see the 30-year fall from this point towards 1.8%. But I've also been making this prediction for a while because people have been saying that the yield curve is inverting for a while. And the last time I thought it was going to invert, I thought it was going to invert around the 1.4% level, which is now where the 3-year is trading, because that's where the 5-year was trading. And at that time, it was the average between the 2-year and the 3-year and everything. So it was looking like it was invert there. But now it's looking like it's going to invert at 1.8. So the whole yield curve, the entire thing is just going up. It's just because of these intraday moves, which can be a lot, and all the macroeconomic narratives that are going around. Nobody's really noticing this happening.
What does it mean, Deso, when the entire yield curve is moving up?
So I'm not entirely sure what the technical economic definition for it is, but the effect of an inverted yield curve is clear. Every single recession in the last 50 years, I think it was, has been preceded by an inverted yield curve.
Yeah.
Where people are more skittish lending people money on the short term than on the long term. It basically indicates a recession is coming. So the fact that the curve is trying to invert, the last inversion, by the way, happened in August of 2019, a month before the repo crisis. That basically means the recession is coming. But the fact that the entire curve is going up means that this is something different. I genuinely think it's the death of the US bond market that we've been predicting for a very long time. I think it's finally happening.
Because what you're seeing is when the entire rate complex moves up, you're seeing more risk in the system. More risk in the system requires more yield. And if it inverts at a higher rate, essentially what you're saying is the system is not healthy, right?
Yeah. The basic function of bonds, which has been suppressed by the government's shenanigans, is to determine how much risk there is lending money to any particular government. So that's why Russian bonds or Mexican bonds have a higher yield than US bonds, because people feel more comfortable lending money to the United States. But the same thing applies at any given yield for any given bond. So if the 1 year for the US is 2% now, and it used to be 1%, well, it doesn't mean that people are twice as unlikely to lend money. It just means that the risk has gone up.
Right.
Which in turn means that there must be a reason for this risk to go up.
So the interest rate essentially is like the risk premium in a way.
Yeah, it's basically, historically speaking, the way to detect the economic health or the credit health of a nation. And if the entire curve is going up, that means that basically nobody wants to touch this. But my biggest worry, my biggest issue, and what's freaking me out the most is, again, that the Fed funds rate has been set to 0.08 effective. And they've just affirmed this in the meeting that happened yesterday. They really want this interest rate to stay here until taper is done in March. Fine. But the bond market says, no, that's not fine. We're going to raise interest rates for you. The only way this is happening, or is possible, is that people just don't want to buy the bonds again, because the prices of bonds and yields are linked and inverted. Yield goes up, price goes down. Price goes up, yield goes down. So the fact that the interest rates on these bonds is going up means that the price is going down. And there's only one way that's happening, is if people don't want to buy the stuff anymore.
And doesn't that essentially mean people aren't buying the Fed's bullshit anymore at this point?
Yes.
That's basically what it means.
That's exactly what it means. It means that no matter what you hear anybody say, you, me, anyone in the markets, doesn't matter. This is the data. This is the chart. This is basically all trades have happened, and now the result is displayed on a graph. That is what we're looking at. And the result of all the trades in the 1 month bond market says that it's already trading at an effective funds rate of 0.5%. Which means that the next 2 rate hikes are not quote unquote priced in. No, they've already happened. It basically is like saying, no, there is no comparison here. There is no comparison. This is an historic event. This hasn't happened in more than, it certainly hasn't happened since 2008, because if you look at the max chart, this bond has been a good little boy when it comes to the Fed funds rate. This goes back to 2008. So you increase that to about here. You can see it looks exactly the same. Except, again, for this bit in the end here, which is when we're living now, which is what has me worried. Again, the bond, it doesn't matter who still believes the Fed's bullshit, the bond market doesn't. And this is the one that matters.
And I would say this, in my experience, bond market investors are probably some of the smartest investors, a lot smarter than stock investors. Stocks, you could pump, Tesla up to 5,000 times earnings and they'd still buy it. The bond investor is like, nah, we don't think so.
Yeah, that's one thing. Equity is not a leading indicator. Never has been, never will be. The bond market is. Now, that is also exactly the reason why the Federal Reserve has been messing with interest rates and buying bonds, doing QE, all the market facilities, all of it. All of it. They've done it exactly because the bond market is a leading indicator. So if they manipulated this indicator and everybody looks at the indicator, then they manipulate and control the entire market. And the short end of the curve just said no. And the fact that this line is going up so steep has me even more worried, because what I've seen over the last 2 years in technical charts is that whenever you have a parabolic line going up, it hits a glass ceiling. I don't know why, but it seems to happen time and time again that at some point, the line goes parabolically up and sideways, might even dip a bit, but it always stops. This line hasn't stopped. This line, the interest rates has gone up 10 times from here, and it's only gotten worse. It's actually gotten so bad that I saw this jump happen in real time. Well, in real time, in this overview here, everything was still like down 1%, except for the 1 year, which was suddenly up 9%. And that was happening last night. I put out a warning, and I even prefaced the warning with, this might be a data error, because it's like this happened so violently and across against all other assets. I was like, nah, this can't be real. It was real. Oh no, it was real. Within 2 days now, it dropped by, what's that, a quarter? Yeah, 25%. Just poof. Again, against the federal funds rate. If the Fed was raising rates and this was happening, fine, fine. Then they were obeying the Fed. But the bonds are not obeying the Fed anymore.
No, the bonds are front running the Fed because they're like, screw you, you guys are incompetent. You know, like you said, they're going to do it for them. They're going to say, no, we're pricing in a risk now. That's what they're doing. They're pricing in a risk now, while the Fed wants to screw around and play games. Because the thing is, the Fed has to be careful. If they raise it too fast, if they taper too fast, if they start actually selling assets running off their balance sheet, you could have that stock market correction like we had in 2018, which is 20% pullback.
Yeah.
So Powell's so worried about that, he's playing games. The bonds are like, screw this. We see what's going on.
Playing games.
Yeah, we see what's going on now that yield curve is starting to rise on the front end, because they see immediate risk. What it means on a 3-month chart or a 1-year chart is more immediate risk when that rate rises, right? So they're seeing more immediate risk, and so they're raising their rates.
To this chart here, to this bond market here, it really does not matter what this chart says. This is all in the past. This has all happened.
That's right. Yeah.
This is a new paradigm. This is happening now. And just look at the 1-year chart. Oh my God.
People are saying, pay me a lot more money to own your debt for 1 year. So that says people think that 2022 is going to be a big year of volatility, right? Volatility, risk, consequences for past actions.
To me, the fact that this is happening on the short end, while the long end is not showing any signs of stress. Well, no, the 30-year is not showing any signs of stress when it should, because if you just go to the 30-year and look at the weekly chart there, there's this cup and handle forming that is formed in every other bond. And the latest trouble started when the 10-year completed its cup and handle. And I got to say, this is the most fucked up handle and cup I've ever seen. But again, if you look at the 1-year chart here, it looks like nothing's really gone on since the last year. But you compare that to the 1-year chart of the 1 year, and it's just, everybody's going to get blindsided by this because everyone's looking at the wrong end of the curve. But the short end of the curve, which should be trading closest to the Fed funds rate, is reacting the most heavily like it's not.
Yeah.
And the longest end of the curve, which should be blowing out in case of trouble, you know, because if you're not going to lend somebody money for 1 year, you're not going to do it for 30 either. Well, they're just not interested, or I not noticing anything or whatever. But I genuinely believe at some point in the future, it's not going to take long anymore, the same thing that happened to Venezuelan bonds is going to happen to US bonds. And I'll show that overview as well. Let's pick this one. Venezuela, the yield curve. because you would expect the longer end to blow out, but that's not what happens. It's actually the short end that completely blows out because the long end simply goes bidless. If nobody wants to buy the bonds at all, you cannot set a new interest rate because you cannot set a new price. But because bonds also form a particular function within a market, meaning a temporary storage of liquidity, the shortest end, or one particular bond for the US, might be the 1 year, it might be the 6-month bond, but one particular bond is basically going to serve the function of minute storage of value. So not 20 years a bond, not 2 years a bond. No, it's your objective to hold that bond for 30 minutes while you line up the next sale. Then you sell that bond to the next guy who needs something to hold for 30 minutes while you buy an asset. And once you've bought that asset, you're not going to touch that bonds again, which means that the liquidity in the bond market goes up, which means price drops, which means yields go up, which means more bonds needs to be printed from a government perspective, which, you know, is the vicious cycle of hyperinflation. And that is why the Venezuelan 20-year is stuck at below 8%, the 15-year at 11.5%, the 5-year at 81.7%, and the 2-year at 92,571.
All right, let's talk silver. Good talk on bonds. You're noticing something in silver. Let's talk about that.
Right.
And the one thing I want to point out before you get into this, Carrion's like a radar when stuff goes off kilter. Like he notices it like right away.
Well, I often, honestly, I just get lucky, but often I also spend the entire day just clicking through charts until one piques my interest. Mm-hmm. That's how we get to these things. But silver, you know, gold, silver pros, has the interest, is down a lot. It was 4% yesterday. The chart flipped over to today, but you know, no one's happy about this. So what happened? What really happened? Well, this one. No, it's not this one. I think it's this one. So a follower of mine in just this sent me a message on Twitter, or general message on Twitter, saying that's a lot of calls. And I looked at this, and what you're looking at is the gold options strike prices. So the COMEX options for gold. Strike prices are here on the left. And you can see around 1825, there's a lot of open interest here. Mm-hmm. There's a lot of open positions. So just at a glance at this, I was like, oh, right. Well, the 26th is options expiry at the COMEX. That's also the same date where, you know, Jerome Powell opened his mouth. So they were going to go down to 1825. And I said, indeed, we'll take quite a bit of effort to slam back down below 1825 before tomorrow. Settlement says January 26th. So I think they still trade tomorrow. Not sure if the COMEX can make that. A day later, the COMEX closed, thanks to Jerome Powell, at 1817. And all these positions, all these calls were worthless. So if you're wondering why the price of gold dropped 2% on a day where silver dropped 1.5%, and that's just not possible, this would be why. And if you're wondering on a day like this, where silver dropped 4% and gold went down another 2% as well, below 1800, then I would like to remind you that Friday the 28th, also this week, is the final day for gold settlement. And the next day, or Monday, the February gold contract delivers on the COMEX. So there was never a chance for recovery today. And if anything, I've noticed that in silver futures, during the COMEX open, there is a squeeze up. Sure, the price drops afterwards, but around my time, the COMEX opens, I don't know, 14 or 15. But you look here, you see, this is 1300. This is too early. The COMEX is still closed. At 1400, we're already a lot lower, and momentum will carry the price lower anyway. After the COMEX opens, the price goes up. Maybe a little bit, but it does go up. And what we're used to, literally used to, because we both have been looking at these charts for a very long time, is that when the COMEX opens, it slams down, and the rest of the price is just momentum for the rest of the day. But ever since the 23rd, I think it was, or here, around that time anyway, silver started squeezing up. Get a better chart of this. 1 week, 1 month? Not really. But since here, COMEX open, price is squeezed up. Now, the price is, gold has not really reacted to this, but I also said that on Twitter. That's because this is a gold delivery month, and they will defend gold harder than silver this month. So some shorts already closed out here. But after that, it just got dragged down by the defense of gold. Next month is going to be a silver delivery month. So I expect more shenanigans to happen in silver again.
Yep.
And all of this simply happens because the COMEX doesn't have what they say to have. I haven't changed my position since, God, more than a year now. Especially today, anniversary of the silver squeeze, 1 year ago now. It's hard to believe that it's been a year. But I still haven't changed my position. I'm still very much of the opinion that they do not have nearly the silver and gold that they say they have. And that is why, and you can check this on the chart, general market option expiry for silver since the May of last year has gotten slammed on the 16th to the 20th, a day before or the day itself of general options market expiry. The only options expiry that they missed was the quarterly expiry in June. But the quarterly expiry in September also got slammed. That was the latest bottom. Then in October, when they actually didn't slam the general market options expiry, and I thought we were over, they started slamming the COMEX options expiry. And the slams have lined up with that date. And of course, the shenanigans they've been performing to the price just to minimize gold and silver deliveries over the past, God, it's almost been 2 years now on that one too. So the shenanigans continue, but also the problem continues. As long as we're stuck at the shitty little price, there is a demand-supply mismatch under the hood. There must be. It's too cheap.
It's too cheap, and we already have silver shortages. We know that from the Silver Institute. We know that from people that produce goods. We know there's a silver shortage, and it was covered up for decades by 50 million ounces of silver the U.S. had, other stockpiles other nations had, because it didn't used to be industrial. They would mine copper, lead, zinc, silver would come out, they'd stick it in a warehouse. Now that it's silver's used in everything, we've been draining that for the past 20, 30 years. That 50 million ounce that we had, according to U.S. Geological Survey, is gone. So the game now is they don't have enough silver. Yeah. And they're playing games in the market. And the question is, when that blows up, what happens? Or in other words, what causes the blow up?
Well, yeah, the only question is what causes the blow up, because we know what happens when it blows up.
Yeah.
But in this case, what causes the blow up, if there is no specific trigger, what causes the blow up is simply time.
Yep. Yep.
If something's undervalued, objectively undervalued, it will get bought by someone, because that is simply arbitrage. And Jesus Christ, like 90% of trade is arbitrage. It's buying somewhere cheap and selling somewhere high and pocketing the difference. That is what arbitrage is. So I guess it makes more sense if you stop looking at the dollar-silver ratio and start looking at any other commodity versus silver. So with crypto collapsing recently, the Bitcoin to silver ratio has absolutely collapsed with it, especially because silver hasn't gone anywhere. But since Bitcoin has collapsed, well, the ratio went up. If you look at the silver wheat ratio, it has also collapsed completely because silver hasn't gone anywhere, but wheat has gone up through the roof, as has all other foodstuffs. So at some point, yeah, you can buy a bunch of food to keep yourself stocked for 6 months to a year, but there's only so much preservable food that you can stock. At some point, if you are expecting a 5-year emergency, you can't stockpile 5 years worth of food. If anything, that just makes you a target for everyone else. So you need something to hold its value so you can buy food during the emergency. And silver's cheap. Now you could buy copper, that also holds its value because we need copper for electrification and such, but copper's already gone up. And there's problems with copper as a copper squeeze as well. So I'm still a fan of copper, sure. But if you look at the max price of copper overall since 1990, it has already gone up. So why would you buy copper when you look at the max price of silver and it hasn't even beaten 2011 yet, anywhere close to?
Yeah, and if you inflation adjust silver, it really it makes it more pronounced.
Oh
because
yeah,
we had $50 silver in 1980, but does anybody believe the dollar's still worth what it was, 40 years ago? Of course not. It may be worth what, 10% of what it was.
I'll tell you one better. That's much more relatable. Forget the 1980 peak. Forget about that. It's too long ago. Situation was different. That's not what matters anymore. If you want a real value adjustment, then look at the 2011 peak. It's not that long ago, right?
No.
It peaked at $50, right?
Yep.
Wrong. Peaked at 60 in today's dollars.
In today's dollars is right because of inflation.
Yeah. Yeah. Yeah.
So it's basically a third, slightly over a third of what it was last time.
Yeah. It already lost 20% of that price in 2011. Like the dollar value of silver in 2011 is now 20% lower. Because you used to be able to buy 1 ounce for 50, and now you need $60 for 1 ounce. If, everything was kept the same. The rest is just paper supply and silver. Just like they added more paper dollars, they added more paper silver.
All right, Kieran, last thing I want you to talk about, because if I let you go without talking about this, people are going to kill me. What about the crypto? What happened to the cryptos? Bitcoin's down. What caused that?
Oh, well, general fuckery in the crypto markets. There's little else to be said about that. It's just a hive of scum and villainy. I actually...
I love how you described that. That's awesome.
Yeah. Actually, if the latest that I saw, and I can recommend this to anyone, I won't show it in full, but I have to just show it. Line goes up. So somebody went through an extraordinary amount of effort, following ideas, to create a 2-hour, 18-minute documentary on what NFTs are and what the problems with them are. And this goes through everything. It even starts at the 2008 financial crisis and gives, according to one of the comments, the most succinct explanation of what happened in 2008 that he's ever seen. So just the intro, just before you can get even close to, God, what was it? NFTs, that takes 40 minutes. Just to understand what NFTs are, just the history of what came before. It explains everything beautifully. There's obviously 2.6 million views in 6 days, and I got it via the algorithm. It's if you have questions about NFTs or anything in crypto, about the current situation of crypto, not what it's supposed to be, not what the grandiose ideas are, not what it could be in the future. No, what it is today and what it turned into. That is the documentary to watch. 2 hours, 80 minutes of your life. It's very entertaining, but there's also a shit ton of info there. You might even want to watch it 2 or 3 times. Yeah,
that's the important thing, is there is the promise or the design of crypto, and there's what it is now, and people aren't equating, or they're equating, what it is now with the intended design. It's not anywhere near. It's too young. Any technology that you put out in its early stages is not going to do, what your 20-year or 30-year view of it is. In other words, we want to build the best internet possible. When the internet first came out, it sucked. I know I was on it in college in 1993. It sucked. We had green screens. It was kind of cool. You could do email. You could, the only way you could download a picture is if you're at your university on a token ring based network. If you're at home, it would take you all day long to download a single picture. The internet back then wasn't great, and it's taken decades, and all that old software, Novell NetWare and AOL and all that stuff is long gone.
Yeah, I think
So,
the only thing I still know that survived those days is the MIDI protocol, which is the protocol for digital music.
Yep. The very simple digital music.
No. Well, that's the bleeps and such you hear, but no, there's actually a lot of data channels within MIDI that control stuff like volume, velocity, and such. That was really designed with the future in mind when it was released. But it's literally the only thing I know that is still in use today of the early computers.
Right.
Well, HTTP, obviously that protocol, because it can be changed, but that's basically been changed to HTTPS because it's more secure, and HTTP wasn't.
Yeah, and back then we were using older protocols in TCP/IP. You're using IPX, NetBEUI, all these other ones, and even that's changed to TCP/IP. And they're even talking about revamping the TCP/IP protocol. So things constantly change. So the thing you have to understand with cryptos is they're not what they're intended to be just yet. And maybe someday they'll get there. We don't know, but they're not there yet.
No, and this documentary line goes up. I would highly recommend to see what the situation is with crypto and today. It's basically, just to sum it all up, one big grift. It got started with lofty goals, but whether it was meant to be or not, it ended up to be the playground of schemers and fraudsters, and it's just a fucking mess. So
I think there are people that legitimately see crypto, working on crypto, developing crypto for its original purpose, because I've talked to some of them. But 9 times out of 10, when I go to a conference and I talk to Bitcoin people, it's all, you must invest, but we don't actually want to talk about the crypto itself, how it works. It's all, no, you just have to believe. It's like a cult. And unfortunately, that damages the credibility for people who are actually working to make it a viable alternative currency, which I think there are a lot of people that want to do that. And I give credit to those people. There are people that legitimately say, no, we need to develop this as an alternative to these fiat currencies. And I respect that. But this sector has been overtaken, like you said, by the grifters, by the scam artists. I've seen so many people that have had past history of jail time or being sued for scams that are now crypto promoters.
Yeah.
It's like they just said crypto is the new email scam, right? Or the new mail scam. Back in the day when you have email and you would send out mail and do chain letters and stuff like that, those people have now migrated over to the crypto sector.
Yeah. Oh, I remember email that went around, a Belgian virus. It was not any virus, it was just an email asking you to delete your System32 folder.
Right.
Those were the days.
Yeah.
But no, look, I am one of those people. You've read my books. I've developed my own crypto system because I understand there is just no value in these crypto systems because they don't offer any utility. They try to solve problems that crypto was never meant to solve with crypto. The example I give in my books is Theta, which I haven't heard anything about in quite a while. So I wonder what's going on. But that's basically a crypto video streaming service, peer-to-peer. And the moment I read that, I was like, well, this is never going to work. Why? Not because I'm against crypto, not at all, but crypto doesn't solve the problem of peer-to-peer video streaming, which is very simple.
You understand there's a problem, and they can tag a crypto to it, and people think crypto is magic, right? It's Harry Potter.
Yeah.
You just wave your wand and it solves the problem.
It would just solve the problem, but it can't. Video streams, very simple. You send a stream from one place to another. You can do that from a consumer PC, which is peer-to-peer, or a central server, which is YouTube. There are no other options. So to then say, well, I'm going to put this very inefficient, slow, power-consuming crypto technology in the middle, why? The peer-to-peer video streaming services that don't use crypto already suck. Because it's either a quality problem or a stability problem, either or. It's never a validation problem. It's never a verification problem. And crypto is still a buzzword that gets attached to everything. that just doesn't need crypto, that doesn't have verification problems. So,
well, yeah, it's a playground, and I don't know. I think crypto has some potential, but right now, like you said, it's the land of the schemers.
Bitcoin has to die. And so, unfortunately, the entire market is basically trading on Bitcoin's trading pattern. You can look up the market capitalization of crypto, and the same without Bitcoin.
Yep.
And the pattern is exactly the same.
It is.
So, unfortunately, until Bitcoin is dead, nobody else is going to get a chance. And Bitcoin will simply die due to the Ponzi schemers running out of legitimate dollars. So why did the coin collapse from this chart from 68,000 down to basically half? And why did it do it twice? It's because because Ponzi schemers, when you think about it, basically employ infinite leverage. So they start out legit. They've got a product and a pile of money, and the pile of money represents the product 1-to-1. And then the pile of money starts to shrink because the product is never real. So over time, as the pile of money shrinks, but the promise of the product stays the same, you could say, well, they now have a pile of money leverage of 2-to-1 because they ran out half the money, but they never delivered a product. And then they burned through another half of their money, but they still don't have a product. Well, now you're 4-to-1 and 8-to-1 and 16-to-1, and you can go on. And at some point, leverage gets so high that a simple bill to pay the power could bankrupt you, because then you need to actually pay that money, but you still don't have a product to generate income, so you just blow up. And everyone who was expecting the products and put money into the product is just not going to get a product ever. And the same is basically happening with Bitcoin, where the product was this futuristic global reserve currency outside of the bankster's control. And the only thing that's been proven over the past year is that it's basically being pumped up by a central bank called Tether. So it is, the problem with crypto is that it has not innovated any of the legacy problems that we have. It's just done them again in a worse way.
All right, Kieran, I think we're going to stop it there. Thank you so much for joining. We'll have you back on.
Well, thank you for having me, and I'll be happy to rejoin anytime.
How can people find you?
Well, they can find me on Twitter at 𝙎𝙄𝙇𝙑𝙀𝙍. They can find me on Twitch, also 𝙎𝙄𝙇𝙑𝙀. I've got my own website, 𝙎𝙄𝙇𝙑𝙀.com, but I haven't updated in a while, so I'm sorry about that. But currently, I'm writing articles for my Substack, so that's 𝙎𝙄𝙇𝙑𝙀.substack.com. I've got another one coming out about inflation pretty soon, about how inflation is never ever going to go away. I thought it would be nice for me to just list every way in which I know that inflation can't go away. And hopefully that'll just convince a few more people.
Very good.
But the bond market doesn't need much convincing anymore.
Thank you, Kieran, so much. We'll see you again.
Thank you. Bye-bye.
Hey, everybody, this is Robert. Thank you so much for watching that video content. I have a couple of quick announcements I'd like to share with you as we head out of this video. I wanted to remind you, you can find us on goldsilverpros.com. We have a free newsletter. If you click here and enter your email address, we'll send that out every Monday to you, as well as we have special precious metals deals with leading bullion dealers here in the United States. If you click that button, you can go here and click on either Miles Franklin or ARK Silver and get the best deals in the business. Once again, thank you guys so much for joining us on the channel. Until next time, this has been Gold Silver Pros.